Moving averages look simple, but they quietly drive trillions in systematic flow. They define trend bias, anchor dynamic support and resistance, and trigger some of the most watched crossover signals in the market. In this session, we are going beyond the basics. We will compare the simple and exponential moving averages on math, lag, and behavior, build a precise crossover playbook with entries and exits, and then stress test it against whipsaws, divergence, and the Confluence filters professionals actually use. The simple moving average is the arithmetic mean of the last n closes. Add the closes, divide by n. Every bar inside the window gets equal weight, and the bar that drops out of the window has the same influence as the newest one. That equal weighting is the SMA's signature. It produces a smooth, stable line, but it also means the average reacts slowly, and it can jump when an old extreme price exits the window, a quirk called the drop-off effect. The exponential moving average solves the lag problem by weighting recent prices more heavily. Today's EMA equals today's close times a smoothing factor alpha, plus yesterday's EMA times 1 minus alpha. Alpha is typically 2 divided by n plus 1, so a 20-period EMA gives the latest close roughly 9.5% weight, with the rest tapering geometrically into the past. Nothing ever fully drops out, which removes the SMA's drop-off jump and produces a faster, more responsive curve. Plot a 50-period SMA and a 50-period EMA on the same chart. Watch the turns. The EMA pivots earlier at swing highs and lows, hugging price more tightly through pullbacks. The SMA lags, but also filters more noise, drifting calmly through minor chop. Neither is objectively better. The EMA is preferred for trend-following systems that need responsive triggers. The SMA is preferred for slower regime filters, where a stable line of bias matters more than reaction speed. Every moving average is a low-pass filter. The longer the look-back, the more noise you remove and the more lag you accept. Shorter periods react fast but generate more false signals. There is no free lunch. A useful rule of thumb, the lag of an SMA is roughly n-1 divided by 2 bars. For an EMA, it is roughly 1 over alpha minus 1, which is about half the equivalent SMA. That is why 9, 21, and 50-period EMAs dominate active trading. A crossover pairs a fast-moving average with a slow one. When the fast crosses above the slow, momentum has shifted bullish. When it crosses below, bearish. The classic combinations are 9 over 21 for swing trades, 50 over 200 for the famous golden and death cross. Mathematically, a crossover is simply the moment the difference between the two averages changes sign. That difference, by the way, is the foundation of the MACD line, so a crossover is really a momentum zero cross. Here is Apple on the daily chart with a 50-period and 200-period moving average. Notice how the 50 curls up through the 200 after price has already established higher lows. By the time the cross prints, the trend is well underway. That is the honest truth about long crossovers. They confirm rather than predict. They keep you on the right side of major regimes, but they will never get you in near the bottom. Use them as bias filters, not timing triggers. For an actionable entry, do not just buy the cross. Wait for the bar that crosses to close, then enter on a pullback to the faster average within the next few bars. This filters intrabar noise and gives you a tighter stop. A second technique is the slope filter. Only take the long cross if the slow average is already sloping up, ensuring you trade with the higher time frame trend. Combine both, and you eliminate a surprising number of low-quality signals before they ever cost you. Exits are where most crossover systems leak money. 3 options. First, exit on the opposite cross. Simple, but it gives back significant open profit. Second, trail a stop under the fast-moving average, exiting only when price closes through it. This locks in trend gains while tolerating shallow pullbacks. Third, use an ATR base trail, 2 to 3 average true ranges below the swing high. The right choice depends on whether you are running a pure trend system or one that scales out into strength. Pick one and stay consistent. The crossover's great weakness is range. When price oscillates inside a horizontal channel, the fast and slow averages cross repeatedly, generating a string of small losses called whipsaws. Backtests of naive crossover systems often show win rates near 35% for exactly this reason. You need a regime filter. The simplest is ADX above 20, which says a trend exists. Another is to require price to be a meaningful distance from the slow average before acting. No filter, no edge. Stack the deck before you take a signal. First, multi-timeframe alignment. Take longs only when the higher timeframe EMA is rising. Second, momentum confirmation. Require RSI above 50 or MACD histogram positive at the cross. Third, volume confirmation. The breakout bar should print above average volume. Fourth, structure. The cross should occur near a higher low or after a breakout above resistance, not in the middle of nowhere. Each filter trims signal count but lifts expectancy. That is the trade you want. 3 traps to avoid. 1. Optimizing periods on historical data until the equity curve looks perfect. That is curve fitting and it will not survive live trading. 2. Switching between SMA and EMA depending on what worked last. Pick the tool that matches your strategy's reaction speed and stick with it. 3. Treating the moving average as hard support. Price slices through these lines all the time. They are statistical means, not magic walls. Respect the slope, the cross, and the distance, not the line itself. To recap, SMA weights equally and lags, EMA weights recent prices and leads. Crossovers signal momentum sign changes, but confirm rather than predict. Filter with ADX, slope, and higher timeframe alignment. Exit with trailing stops, not hope. Tomorrow, open one chart you already trade, drop on a 9 and 21 EMA, mark every cross of the last 6 months, and score which ones passed your filters. That single exercise will teach you more than any backtest. This is education, not financial advice. Trade your own plan. If this helped, do me a favor. Hit the like button, subscribe, and tap the bell so you don't miss the next one. See you in the next video.